it's financial accounting we do here, it must be measurable in monetary units. I mean, in the very first lecture I was telling you that there are some other forms of accounting where not everything is measured in monetary unit, but for us here in financial accounting, it only qualifies as an asset if we can do this. And that's why a lot of things, even though they can generate economic benefits for the owners, will not end up on the balance sheet or the statement of financial position because it's not reliably measurable. And we will talk a little bit more about this today. Then, as I said, next step we want to talk about is basically the claims. So if you look at the financial statement, the statement of financial position, the first part is basically a summary of the assets in the firm, and the second part is who has claims over these assets, basically. And the claims we can divide into this two main parts we already also discussed, that is, owners, equity, and then those that provide funds to the firm but do not become owners, so lenders basically. Yeah? So these are the two main claims. So here we have these two types of claims of the business: equity, claim of owners, and the liabilities, so claims of other parties, usually banks that lend some money to the firm, or if we further differentiate between non-current liabilities and current liabilities, also suppliers who, delivered their supplies already to the respective company, but were not paid yet. Yeah? So these are all liabilities. Now we go on with an example, with an additional example. So we add a little bit more flesh to the bones compared to this first example with this Paul guy and this paper business. And here, we start to look at these different transactions. So transactions, what is this? Well, in the end, it's if you remember back to the very first lecture, I showed you this picture with the firm in the middle, and then we had these different markets. And all interaction with these markets are basically transactions, and this is what we look at here. So we have the starting information, some business that was created by depositing 30,000 in a bank account, plus 16,000 raised. And we have this additional information where these 30,000 come from. 16,000 were raised from the owner, so that is equity, where 14,000 are borrowed, so that's debt, some liability. So you see these two different claimants here. And then we have these different transactions going on, and what we do is we will look how they map into the balance sheet, the statement of financial position. So these statements, they basically start with assets. Okay, now I was telling you that there are two types of assets, non-current assets and current assets. So if we only consider the 1st of March, what type of assets are there? Cash, and that qualifies as current assets, yes. So we only have current assets. And that's cash. And this cash it's basically 30,000. So if we write this in the balance sheet, here on the asset side, it does not matter where it comes from. So there we do not differentiate between this 16 and 14, right? And that's basically all we have in assets. So our total assets sum up to 30,000. Now, second part of the statement of financial position, basically equity and liabilities. So what do we have here? First we start with equity. What's equity? Pardon? So 30,000? Pardon? Is this all equity? 16,000. Only part of this cash is equity. Yeah? So only 16 out of this 30 the owners, the investors have a claim on. Yeah? And the rest, what's the rest? It's some liability. I mean, here it does not say much about whether this is long-term or short-term. I would assume it's meant rather long-term, so this will be a non-current liability. Some long-term borrowing we made in order to start this business. Yeah? Borrowing, and this is 40. Yeah? So if you take the sum of the total equity and liability, you have this 30,000. So you see the sum of equity plus liabilities equals the sum of assets, the total assets. Yeah? So this is our starting point. Okay, now we go on. So what happens after the second day? What happens if this firm buys a motor van for 15,000? What will be affected here? Cash? How? Exactly, so we have to add an additional item on the balance sheet, some non-current asset. Cash is reduced, but instead we now have some non-current asset here. So what we have is I'm thinking a little bit. Whether I should write it down here or whether I should open an Excel file. I mean, you cannot use Excel in the exam, but it might be easier to read and more convenient. So maybe I do this. Let me just, so we can put these things in easily and we get the idea of how this works. So let me just quickly start with this. So that was cash. Total assets. Equity and liabilities. There we have equity. Right. Then this long-term borrowing. Okay, so this was 30,000. So there's not much. Let's just this. Then equity. Maybe let's first do this long-term borrowing. And when I say something, let me just fatten this so you see what are kind of headlines. Okay, so what you should know by now is that the total of equity plus liabilities equals assets. So that's this basic accounting equation that is emphasized in the book quite a lot. That means we do not really need to calculate something here, but we can just say, well, this is the total assets if we took the sum already there. Yeah? But knowing this, the sum, the total of equity plus liabilities equals the total assets, allows us to quickly calculate the equity. I mean, here we got the number, but later on it might go smoother. Instead of manually calculating the equity by simply taking, well, the sum minus the liabilities here, and then you got this 16,000 and everything is fine. Okay, so this is our starting point. Now let me maybe copy this, but just the values. No, this is not so nice. Let's do it like this. Okay, and now let's think what happens. So you have everything. It's a little small, but okay. So now this firm buys a motor van for 15,000. And it's correct what you said. So cash goes down by 15,000. So instead of having this 30,000, we have to subtract 15,000, right? And 15 is left. However, as you also said correctly, there's something more now. We now have these non-current assets. This. And this was worth 15, right? This up again. Okay, and if we now calculate the total assets, it's basically this and this. You see, nothing changes. So it was really just a swap between assets, which has no effect on the wealth of the firm. Yeah? So equity does not change further. With the liabilities, nothing is going on because everything was paid in cash. So this transaction has no effect on equity, no effect on profit. It's really just a swap between two positions in the upper part of the balance sheet, right? Okay, and as nothing happened here, total assets stay the same, nothing happens here as well. Yeah? So we can keep this. Okay, then next case. Let's just again start with the numbers we have here. What is it? The firm buys inventory on a month credit for 3,000. Okay, so two things are going on here. The firm buys inventory, so we need another asset type here. Where's inventory? Is this non-current current? Current, exactly. So we now have inventory. What's the amount? 3,000. Okay, and now it's not paid in cash, but on 1 month's credit. What does that mean? It's a liability, exactly. And what type of liability? If we started to differentiate between current and non-current? It's a current liability, exactly. So let's also add something here. And do you know the common term for such types of liabilities? Pardon? Exactly. Okay, and this is 3,000. So we got a different, let me do the sums again. So we got this, oops. So this, okay. Then this, and equity is now this minus these liabilities. Okay, I think this fits. Okay, so what we see here is kind of the next type of transaction. So we do not have a swap between assets, but our assets increase, but at the same time the liabilities increase. So that means there's also no profit involved. That's why equity stays the same. Yeah? However, the sum of the total assets increased now. Yeah? So you see, only having more asset does not necessarily mean more wealth, because, well, you now have more asset, but on the other hand, you at the same time have more debt. Yeah? So your wealth stays basically the same. That's basically what's meant by this case. Yeah? Now, what happens if this firm repays 2,000 of the amount borrowed? How can we map this? I will not copy paste, I will just work on this, so we change step by step. What happens if there's this repayment of something borrowed? What's affected? Yeah. Pardon? Exactly. So two things get reduced. Cash gets reduced and the long-term liability gets reduced. Yeah? So if we want to do this here, we basically start from this 15,000 and what is it? 2,000, right? Reduce it by 2,000. Yeah? However, the long-term borrowing also goes down by 2,000. Yeah? So you see, it's basically the opposite of the previous case where this inventory was bought. Yeah? Assets are reduced, but at the same time the liabilities are reduced. Again, it's not wealth generating or destroying, equity stays the same. Yeah? However, the bottom line number, the total assets and the sum of equity and debt changed. This decreased. Now, what what happens if the owner introduces another 4,000 into the business bank account? What's affected? You wanted to say the same? Cash and equity both increase, right? So we can take this and add this 4,000. And now I don't have to calculate anything because I still have the formula in here. Nothing changes with the liabilities, so the equity goes up by this 4,000 and stands now at 20,000, right? So we now have more equity, we have more cash. However, be careful, this is not profit, right? So because it's some new monies the owners invested into the firm, equity goes up, but it's not profit from the, well, from the firm's business itself. Okay, and now what we have is that the firm sells all inventory for 5,000 and with an immediate payment. And this is the only case where really profit is generated. And can you tell me, looking at these numbers, why there is some profit made by this transaction? Exactly. So we get 5,000, however the inventory only costs 3,000. So let me, maybe for this case, really make a copy of this. Or we do it like that. And here I just paste the plain numbers. So, what we have is inventory goes down by 3,000 because everything is sold. Yeah? Then we get cash, but we get more cash than this 3,000. We get, it is immediate payment, yes. We get 5,000. Yeah? So total assets go up by 20,000, and at the same time, the equity needs to go up by 20,000. Liabilities are not affected, and in order to fulfill this equation, assets equal equity plus liabilities, equity needs to go up. So this is a case that reflects profit because, well, inventory worth 3,000 was sold for 5,000, so for 2,000 more. Yeah? And that's basically it. Are there questions about these cases transactions? Pardon? It's 3,000 if we did not do something wrong, and it's this the third day. They buy inventory for 3,000, and then the trade payable is 3,000. It's not just paid, so there's no transaction showing that it's paid back, right? Pardon? This is from the long-term borrowing. That was 14. So the question was about the 2,000, where they went. Long-term borrowing went down by 2,000, so it went from 14 to 12. And at the same time, cash went down in this case. Yeah? Okay, so what is important for you is really to understand the differences between these cases. So there are transactions which is basically just shifting assets between the different positions. Yeah? Nothing happens with equity, nothing happens with liability, and nothing happens with the total of assets and total of equity and liabilities. Then we have cases where both parts could go up. Yeah? So either liability and assets increase or equity and assets increase. Yeah? And then we might have the case, this last cases, where we really have transactions where profit is generated, and there usually assets go up, and because liabilities do not go up, equity needs necessarily go up. So the profit is then directly reflected in the equity, right? And that's basically the reason why we can infer on the profit if we compare last year's balance sheet with this year's balance sheet. The difference in equity shows whether there was a profit, or if it's a negative difference, whether there was a loss, right? However, we do not know where this profit came from if we just do this comparison of these, let's say, states. Okay, so having done this, I think we can go back to the slides. No, there's one more case here. Okay, it's an adjustment. I mean, maybe I don't do it in Excel, but you tell me what would happen in this case. So instead of selling everything for 5,000, now everything, all the inventory is sold for 1,000. What does this reflect? It's a loss, exactly. And how high is the loss? It's 2,000. The difference between 3,000 work inventory and getting 1,000. What will happen is basically cash goes up by 1,000. Inventory will, however, go down by 3,000. There is no change in the liabilities. That means where the loss in equity goes down by this difference. So instead of equity going up by, what was it, 2,000? In our previous example, here equity would go down by this 2,000 loss. Okay, very good. Then let's see what's next. Yeah, this is kind of a reminder. So what we did now, we did set up a balance sheet for every day. Usually this is not done, so these transactions are all collected, and yeah, the usual thing is basically yearly reporting. But I think we talked about this when we talked about the differences between financial accounting and managerial accounting. Yeah? Yeah, here it's again this link. Okay, so we can extend our basic accounting equation. Total asset equals assets plus liability, and look at it a little bit more differentiated. So basically the assets at the end of the period equal the equity at the beginning plus profit of this respective period plus the liabilities at the end of the period. Yeah? So last year's equity plus this year's profit plus this year's liability gives this year's asset. So you see we extended this by this middle line profit, or if there was a loss, of course, we have to deduct it, not add it. Yeah? However, this only holds if we assume that owners do not make injections or withdrawals of equity during the period, then we would have to control for that too. That means for our previous example where we had this injection of new money, this would not pan out. Yeah? But I think if you look at the numbers, you should be able to see this. Okay, I think we talked about this already, the classification of assets, when something is current and when it's not current. So non-current, that's usually the assets held for a long term, where the current assets are held for a short term, and the rule of thumb is basically, well, you should not have it longer than 1 year, and it should be held for sale or consumption during the business normal operating cycle. So the textbook gives you this graph of the operating cycle. So if you have some trade firm, usually they buy inventories, then they somehow produce something out of these inventories, and then they sell this. They get trade receivables, so it's very common that customers do not pay immediately, but you get this trade receivables, but shortly after you get the cash, and then this whole circle starts again. And everything that is kind of normal delays within this circle is then classified as current assets. Yeah. So this is basically the rule of thumb. Yeah. Then non-current assets. It's basically everything that is not current, and as I think we discussed this last week, we have this differentiation there between tangible assets and intangible assets, right? But this is something that is not specifically, or the assets are not labeled like that specifically in the balance sheet. We just should be aware of them, and you should be aware of the issues that come with the measurability of these things, because it's often a little bit harder for intangible assets. Okay. Well, same classifications for the claims. So equity. In our course, we do not differentiate between different types of equity. I think there are a few examples where there is this differentiation. So dependent on the financial reporting standards, this firm is, this firm has to report under. There might be different forms how to show this. So usually not all profit can, for example, be paid out to the owners immediately, but some profit needs to stay in the firm, and then, well, depending on the exposition of this equity part in the financial statements, this retained profit is somehow stated as an extra point. So we just meshed everything together, right? This 40,000 from the beginning plus the profit made in this last transaction. But of course you can also say, well, we had the starting capital of 14,000, and then we had the profit of 2,000, and the sum is the total equity. Yeah? So that's the point here. But there is a differentiation with the liabilities. So current liabilities, really definition in line with the current asset, as long as these liabilities occur within this normal operating circle, it's current. So if the firm, well, usually pays back these liabilities early and quick, it's current. Whereas, as in our example, if a business is started or a new project is financed, as we had in our this alpha and V example, this is usually long-term debt, and so non-current liabilities. Yeah? Okay. Last discussion point. I think we can do this before the break. Can you give me a few examples of current, non-current assets and current and non-current liabilities? So what are the main? Current is cash, yes. Equipment is what? So maybe I misunderstand equipment. Is equipment, so in terms of the book you have fixtures and fittings, is this what you have in mind with equipment, or is it more inventories? Fixture and fittings, is it current or non-current? It's non-current. Fixtures and fittings usually are non-current. So, I mean, they are usually not there for sale, right? I mean, they are part of the factory buildings, office buildings, and so on, yeah? But it's nothing that will be bought and sold within this business cycle, right? It's kind of out there, yeah? I mean, of course, you can liquidate it relatively quick if you want, but it's not intended to be liquidated, yeah? So fixtures and fittings is basically one of the non-current assets. Other examples? Yeah? Cash equivalents, what's that? Okay, so some financial instruments that can be quickly converted into cash, right? So the term you mentioned is cash equivalents, right? This is also something that could be shown here. So all types of short-term investments are considered as current, yeah? So if the firm has lying around a lot of cash and buys some stock, yeah, then it's a current thing. It classifies as current. Whereas if we stay with this stock example, if a firm really does some long-term investment in another firm, it might also classify as non-current if it's an investment, even though it's also stock. So it really depends a little bit on the case. That's why we in this course do not care too much about these things. Okay, so yeah, I think you all get an idea. With the assets, liabilities, are there some liability examples? Bank overdraft, what's that? I mean, we have this in a few exercises. What does this mean? Yes, you have some account and you take out too much money, more than there was on the account. You have this minus sign or a red number, that's bank overdraft. And usually it's not intended to have this over more than a year, but only for a short period. So this is something. And actually in the second half of the lecture we will do some exercise today. And there's also, we start with bank overdraft, yeah, in this example. So we have this current liability, and then in the turn of these transactions, this overdraft will turn into some positive number. So we will have this shift from this current liability to current assets. So if your account becomes positive again, it's an asset. Okay, yeah, nice example. Non-current liabilities, I mean, I think we talked about this. It's really funds raised by banks or lenders to make specific investments and so on. So long-term borrowing. Okay, I think let's have a break and start at 9 again.